we've been talking the last couple of weeks. Actually, I'm starting to feel a little bit better about earnings because the dollar is weak. The dollar has pulled back, and that hurt earnings for multinationals 5 to 8% last quarter alone. So the dollar weakness is a good thing, I think. Right?
You know, it is. Dollar index lowest level, I think, since June.
Right. Input costs are coming down. Supply chains are actually freeing up a little bit. So, yeah, demand is going to be the question mark, but maybe companies can offset the weak demand with a little bit other help, a few more tailwinds that we haven't had in a very long time.
Now, I could easily go to Jim Libenthal here, who would suggest that he thinks that we could have a year-end rally, too. However, I'm going to go to Joe first. I want to know.
Nice tease.
Well, because I think I know what side of the boat you're on, and I'm not exactly sure today what side Joe's on. 4,400 would be a 9% upside from here. 45 is 11.5. That's Tom Lee, okay? Is it time to buy into the rally? I mean, I don't know if you want to even call it a rally at this point, or fade it. Simple question. Two different strategies.
Okay, last week, I expected us to get a Federal Reserve-driven rally into the end of the week. We got that. Now can the market go another 10% through the remainder of the year towards 4,500? Let's say it can. I still don't want to take that trade. And
Do you think it can or not?
Over the
bottom line is, like, if you all right, everybody wants to answer to the same question. Everybody wants to answer the same question. Joe, do you think we're going to have a rally into the end of the year, or are those hopes dashed?
December 13th, 8:30 in the morning. It's all dependent upon December 13th.
CPI
at 8:30 in the morning. What is CPI? Last time CPI came out in November, what did the market rally? 7% off of that? Okay, so the market on a benign number could easily read. But I want to finish my thought for a second.
Please.
What happens after 44? Let's say on December 31st, we're at 4,500. What happens thereafter? You have to ask yourself that question. Is the overwhelming amount of challenging headwinds that have hamstrung the market for the entirety of 2022 on December 31st, do you have clarity resolved? No, you don't. So I think that you have to be cautious. I think to Steph's point, you have to maintain.
Well, Steph said their earnings may be better than people think.
They could
to your point of what happens after.
But I still want defensive positioning. And I'll tell you one other thing from an asset allocation perspective, and I'm hearing this in a lot of conversations that I'm having. On January 1st, when you measure equities relative to fixed income and now the emerging markets with China reopening, there's a lot of renewed interest in fixed income in a rebalancing opportunity and the emerging markets.
So if you look at the data that Steph points to today, obviously it's not pointing to a recession, okay? The jobs data is not pointing to a recession either. Wages are up. The Journal today puts out the idea that the Fed is penciling in their words, higher rates for next year because in part of wage growth. And maybe that's in part what the market doesn't like today is more economic data that's strong means that they need to stay more engaged. That in and of itself puts a cap on the market and the economy for that matter.
Depending, Scott, on what actually happens with inflation. I'm looking at my screen right now. I'm looking at gasoline futures. They're at $2.24 a gallon, which is below the level on December 31st of last year. So all of Ukraine, all of that impact on fuel, take it out.
No, the Fed doesn't care about that, though.
Absolutely.
No, not as much. They care more about wages, right? You know that.
What they care about, we've had this argument before, is CPI. CPI. We're going to agree on that. They care on CPI. What goes into CPI includes wages. It also includes rents. It also includes goods prices. It also includes fuel prices. So what I'm saying is relevant. What you're saying is relevant, too. What I'm trying to dictate here, what I'm trying to put forth is the idea of a soft landing, the odds of that are increasing. But that means that I believe so, because what is a soft landing? It's full employment, which we've clearly got. It's a strong economy, which we've clearly got. And it's decreasing inflation. Now, this is a hypothesis that is partially proven out by the October inflation number. But Joe makes a good point. You have to see November's inflation number. We have PPI this Friday. You have to get those inflation numbers to determine, was October a blip? Or was it the start of a real trend of inflation coming down more rapidly than the market or even the Fed thinks? I went to the fuel, and I'm not disagreeing with what you're saying about
headline, right? They don't,
It matters.